The S&P 500 and the Nasdaq drifting higher Wednesday afternoon, hitting all-time highs. Let's get inside the markets with Erik Oros. He is Chief Investment Officer at Gideon Strategic Partners in Baltimore, Maryland. Welcome to our program, Erik.
Hey, Fred. Thank you for having me.
Great to have you with us. Well, Erik, we've got Bitcoin trading back up near just south of the 50,000 level. We've got meme stocks like AMC up 27% over the last 2 days in high, heavy volume at that. Are the markets overheated? The equity markets, that is.
Well, I think certainly valuations remain elevated, and a lot of the reason for that we've seen has been a massive tailwind in the form of fiscal and monetary support that's really existed over the last 18 months. We've had an incredible amount of stimulus coming from the government that has, if we look into the back half of the year, might turn into a headwind in the form of higher taxes. And certainly from a monetary standpoint, we're going to learn a lot more later this week in Jackson Hole. But the question isn't necessarily when they're going to taper, but how much and how the market will react to it. And you add in very elevated valuations, and certainly it's a type of market where I think you have to be very picky about where you're deploying fresh capital.
And right now you've got, for example, bond yields, the treasury yields just below 1.3%. You've got consumer sentiment that's down sharply, yet many stocks trade at near record highs or at record highs. So who's right, Erik? Is it the bond investor, the consumer, the equity market?
Yeah, well, the bond market has had a wild ride this year, and it's very interesting kind of the takeaways that have come from that. At the start of this year, we saw the bond market really take a beating with the idea that the reflation trade was going to take hold, the economy was overheating, inflation was very tight. And then over the summer, we saw a real rethink in the form of maybe reluctance of the Fed to begin their tapering program, but I think more of it had to do with the economic numbers starting to disappoint.
So put it all together, the bond market, the economy, earnings and all, the valuations. What does it tell you about the sustainability of this stock market rally?
Well, I think many investors have kind of learned the hard way that valuation is a very poor indicator of short-term performance. It's always said that shorting a stock on valuation is a very poor decision. But it's a very good indicator of medium to long-term performance. And so what I think investors need to realize is that expected returns over the next decade are likely to be a lot more challenged. And a lot of the multiple expansion that's driven the market higher over the past 12 years really is going to be a lot harder to come by when you look at things like Schiller Cape at near all-time highs. And so we've recommended our clients very much look toward more idiosyncratic risk factors, companies that can execute on a game plan and operationally to drive value rather than momentum or market multiple expansion to really drive returns.
Well, today, Erik, the House approved that $3.5 billion budget framework. What factor is it in driving investor sentiment today?
Well, I think that the passing of that framework today will be interesting to see what's under the hood. I think one thing that investors are going to be hyper-focused on is the tax implications. There's been a lot of talk about capital gains tax increases, removal of 1031s, all sorts of things. We just don't know currently, but that's certainly something we have to look out for in terms of really becoming a fiscal headwind into the back half of the year and into 2022.
And what does that passage mean for the reflation trade?
Well, I think there's I don't know if I'd call it a misconception, but there might be some misled optimism around this package and the infrastructure package as well, and that when you look inside of these packages, the amount of money that actually is going to hit the market is materially lower than the incredibly large $1 trillion COVID relief packages. For example, infrastructure, $1 billion or $1 trillion being the kind of target. We'll see if it gets done. Either way, it's going to be over 10 years. So $100 billion a year compared to north of $4 trillion of stimulus, kind of a drop in the bucket.
All right. Well, thank you, Erik, for your thoughts.
Absolutely.
Our thanks to Erik Oros of Gideon Strategic Partners. I'm Fred Katayama in New York. This is Reuters.